let me quickly welcome on board Anirudh Garg, partner and fund manager at INVasset PMS, to talk to us about his views with regard to where markets are at. Welcome, Anirudh. First off, just with regard to how markets have been, they've been buoyant. You expect this kind of run to continue, or you expect some bit of correction or a sideways movement, a time-wise correction? What's your sense?
A very good afternoon to all the viewers of NDTV Profit. Thank you for having me. I believe that somewhere our markets have run up a little bit more than what was justified. And other markets like US and all, they have some catching up to do. So we believe that though we are not seeing a major correction coming through, but yes, you could see some sideways movement until laggards like the banking index, the Bank Nifty and the others catch up. So we believe that the momentum in the market has shifted from, the capital goods and Capex themes and all the themes that were out there to somewhere for where the value was. So we believe going forward, the new economy part of the market, which is IT and Fmcg and all, they would now take control of the gas, and Nifty as compared to other indexes, especially the US, should be a little sideways and underperform.
Anirudh, it's been a very theme-centric market. You've seen banks at times underperform for long periods. You've seen certain sectors underperform for long periods and thereafter come to the fore, do very, very well over a period of 3 to 6 to 12 months. We've seen that real estate has done very, very well. We've seen railways, the Capex plays doing very well. We've seen cap goods do very, very well. What's your pick? What's the next round of rotation going to be like, and which are those spaces where there is still value?
Sure. So see how we believe at INVasset that this is primarily an old economy run. The basic theme of the run is an old economy run in which you have only two things to participate: is either interest rate sensitives to participate, or you will see capital expenditure coming forward. This time it was very, very clear that as far as interest rates are concerned, which require, global growth and global inflation under control, both of which were a problem for the last couple of years, they did not participate as much as was expected. When it comes to Capex did wonders for the Indian economy thanks to the buoyant budgets of the Indian government. Going forward, I believe that somewhere based on risk-reward ratios for every sector that we have, we believe that they have run up a bit too much, and there is a scope for sideways to price correction in the sectors that have outperformed till now. Somewhere we feel that the new sectors which have not performed in the last few years, something like an IT or an Fmcg, should take the reins. We believe pharma at this level is also a bit overvalued and has run up a bit more than expected. But they're all the views. But yeah, in terms of the leaders that were till today, we are seeing a major shift happening from capital goods, railways, defense, infrastructure, power, to safer defensive sectors like Fmcg and IT as a tool.
So you're buying into large cap IT, you're buying into ER&D, you're buying into mid cap IT, or you're buying into IT enabled businesses?
Okay, so hi Neeraj, for us we are buying into primarily large cap IT because we move to these defensive sectors to take a protection in overall expensive markets, and also to take an advantage from the underperformance that they have had till today. So primarily we are buying into large cap IT and very specialized IT, which is concerned with doing newer things. For example, somebody is into designing electronic vehicles and their parts and their R&D. So we are into such sectors in IT specifically where things are changing. They are catering to something new. Apart from that, we are buying large cap IT.
Okay. So the other aspect is with the Fed rate cut around the corner, should some of the global facing sectors be a part of a tactical portfolio? You may not keep a tactical portfolio, but I'm just trying to understand. If you had a choice, would you do that?
Yeah, actually we do keep tactical portfolios.
Okay.
Yeah, we do keep tactical portfolios, but somewhere we believe that let the run play through. It's an expensive market right now, and we have no doubts in it. on a large cap basis, if we talk about the Nifty as per se, it's not that expensive. We do not believe that there is more than a 10%, 10 to 12% downfall in the worst case scenario for the Nifty 50. But when it comes to the mid caps and the other sectors that have run up in the last, say, 1.5 to 2 years, there can be a significant downside in the next 3 to 6 months. So when this happens, generally, it's okay to keep a tactical portfolio. It's okay to predict what is going to happen, the next sector that is going to come out. But I believe that we will find lower levels going forward. Yes, but we'll keep nibbling to them as and when they correct. You're absolutely right that inflation is now coming under control. But what we are not seeing right now is the global growth, especially the China factor is hampering a bit. But yeah, that is also, we believe, in the very near distant future, the problem should be solved. It needs just a little bit of more time. You have to complete that antibiotic course, which is China is going through.
Understood. You like FMCG, Anirudh. Talk to us about what within FMCG. Is it more rural facing? Is it QSR? Is it how would you play this?
So again, in FMCG also, either somebody who's doing something the way it not has been done before, who some e-players, I consider them into FMCG, who have changed the way the business was done. I think QSR for us is a thing of the past. With these new apps coming in, you have a variety of choices now, and you're not dependent on a particular pizza or a burger company. You have a lot of choices, and things in that phase for the Indian economy and the world are changing at a very, very fast pace. I believe the rural is the way forward. It was due for a very, very long time, and there is value in the rural facing FMCG stocks. So we are a little bullish on the FMCG. But that too, again, because we believe that the inherent growth questions of the economy, the inherent sectors which had to lead this run are now expensive. I think more expensive and have run up their course in a very short period of time.
Right, Anirudh. And Anirudh, last off, with regard to some of these new age tech companies, call it a Nykaa, call it a Paytm, call it a PB Fintech. Today, Nykaa is obviously up and away in trade. What's your sense? Do you like any of them? Would you be participating in any of them?
So I am not a fan of new age companies until and unless I am a regular user in them. This is something that, or we see something changing in those companies. So there are a few companies that we like. Some companies that have become, that have, replaced, I would go to the extent of saying that have replaced the way the business was done, something that have shaken up my FMCG basket that was, that was the same for the last 20, 30 years. And last 20 years, it has been the same and has now been shaken. So yeah, a few companies like Zomato, though it's not a recommendation to buy and sell, I believe should lead the way forward. They're a little bit expensive, but yes, that is where the business is being done. And no, I'm not a fan of Nykaa as such. Yeah, though we are diving into the numbers this time and trying to see how they are shaking up things, how things are being done differently. But yes, everything is becoming fast, and somewhere the way Zepto and Blinkit and all these all these apps have changed the way the business was perceived. FMCG is also, I believe, to be perceived differently now.
Okay, thank you so much, Anirudh. It's been a pleasure chatting, breaking down some of